Hi everyone, I'm Casey, and in this video I'm going to be teaching you all how to read stock charts. Now, the program I'm going to be using is called Thinkorswim. It's a free program provided by TD Ameritrade. If you want to use it and follow along and learn, then make an account, as I said, for free on TD Ameritrade, and then you can download Thinkorswim and log in with that new account. Now, I'm going to be going over the techniques that I use. A quick thing I wanted to mention before I get in is, although these techniques can be used for day trading and swing trading, basically very short term to medium term trading, I don't necessarily want to encourage that on my channel. Although I'm going to go through how to do it and utilize those signals, I use these mainly for figuring out whether or not, if I want to buy a stock, whether now is a good time to do so or not. And if I'm thinking of selling a stock and exiting a position, is it a good time to do it as well? So now, starting off here, what I want to do is go through how to make your workspace, which is essentially what you are looking at and using Thinkorswim for, to look like mine. So just a quick overview. Right up here on the left side is where you're going to find your tickers. Right now we're looking at Microsoft, and it's going to tell you the price it was at, the percent change it had for the day, as well as the dollar amount change for the day. And up here is where you're going to get your time frame. And if you want to add a certain time frame, like I'm looking at the 6-month, or in other words, 180-day chart with a 4-hour aggregate of price, you can customize the list and add some there. Now, in order to get this to all look the same, first, you want to make sure you're on charts in order to see this, because when it first comes up, it might be on something like that. You go over here to studies, you click edit studies, and these are the ones that you want to add. I have the exponential moving average, the simple moving average, the RSI, and the MACD indicators. Now, in order to get those, you just type in over here their name, and then you click add, and make sure when the options come up, you choose the same ones that I have. If you want it to look exactly the same, like for RSI, you do 1470, 30, close, while there's no, etc., etc., and make sure these ones are up top and these ones are on these lower portions. Now, what I want to go through first is the MACD. The MACD stands for moving average convergence and divergence. So basically, it's two moving averages. When they come together, it creates a signal, and when they start to come apart and diverge, it makes a signal as well. And we're going to go through how to read them. Granted, all of these signals are super important to use in conjunction with all of them all together, get confirmation, and we'll get all into that. But the MACD is my favorite one. It's kind of the overarching signal, if you will. So the MACD is right down here, and basically, if you chose this little yes when you set it up, then you're going to be getting these red and green arrows, and these red and green arrows at the bottom are buy and sell signals. So this is what's called a leading indicator, which basically means that it indicates that something could be a buy or a sell before it happens. Now, the important part of that is you want to wait for confirmation before that happens, and what I mean by confirmation we'll go through right now. So, for instance, if you look right here, when Microsoft had this big price movement, you can see the green arrow down here signaled a buy. These moving averages converged, and then they started to diverge, right? Hence the name. And we could see that these little green bars, if we zoom in some more, they became bright green, which means the increases in price are increasing, right? The delta, the change of the price is growing. So a price, in this case of Microsoft, it may have been 180 and then went to 181, and then from 181 to 183. So the price change was $1, and then it was $2, so on and so forth. When they become dark green, like it did right here, that means that the price is still increasing, but the delta, the amount of change, is not increasing anymore. So it may have went from 181 to 183, and then from 183 to 184, right? So it went up 1, went up 2, and then went up again, but only by 1. So when we see a few green bars, especially the bright green ones, that's a really good sign that this is going to be happening. Now, the reason why I wanted to talk about confirmation, if we find a good example, this is a pretty decent example where we had a couple green bars, but then right after them we had a dark green bar, and the price didn't really go anywhere. It was pretty much flat. And if you bought right here, just going off of the MACD, and as I said, and we'll get into, you can you really want to use all of these in conjunction. By the time it told you to sell, you would have been up 1.5%, and really quick to go through that. To show you where you see a percent right up here where my cursor is right now. When you click and draw a line, that's when you'll see the percent. And you want to make sure that in order to do that, you have your drawing tools over here, and it's this line right here. So anyway, back to the MACD. When you wait for confirmation and you get a few bright green bars, and then right here you see some dark green bars, so you may not want to buy yet, right? You want to wait for this confirmation I'm talking about, and here's a great example of it. Right here, even though the buy signal was back here, if you waited a day, these gray columns are after hours, and these dark columns are the days. So literally just a day and a half later, you get one bright green bar, 2, 3, 4, 5, 6, and they keep getting bigger and bigger, and that's when we could tell that this right here, for instance, is a good buy signal. Now to flip over to the sell signals, this is what I mean again by waiting for confirmation. Is this was, there must have been something that happened in the market. I'm not sure exactly. This was July 7th if you want to look it up. You'll always see the date up here on the top left for wherever your cursor is. There was a few dark red, which basically means the decreases are increasing. It's the same thing as when it's green. But it wasn't a for sure sign, because let's say you sold right here when it told you to. Well, it went back up about almost 3%. So again, if you wanted to go off of these for day trading, or more importantly, in my opinion, swing trading, they're a lot better for. This was a good example where you didn't really get a lot of confirmation. It was kind of flat here. There was only a few bright red ones, and they were pretty small. But right here you got 1, 2, 3, 4. And in certain situations, this is why I don't necessarily say that you should be using these to day trade or swing trade, because I think investing for the long term is really important. It wouldn't really have mattered in this situation. I'm not sure if this was their earnings or what necessarily happened, because this dropped a ton. It dropped almost 5 or 4.5%. It looks like it got down to almost 6% at one point. So anyway, the MACD, I think we've covered it enough. I've kind of gone in depth for the most part, and definitely comment down below if you have any questions. But again, this is more for figuring out if you want to enter a position or not, if you should hold off, or if you want to sell something, hold off for a bit. That's where I think these are great for. So moving into the RSI, which stands for Relative Strength Index, it is essentially a indicator that measures supply and demand. The focus was going crazy there for a second. As I said, it's a measure of supply and demand. So basically, when a stock price is going down, stock prices in general have to do with supply and demand. When a stock price is going down, there are too many sellers than there are enough buyers. So the buyers can be greedy, and they can say, oh no, I don't want to buy it for $10. I want to buy it for $8 because there's so many sellers. Somebody who wants to get rid of it enough will drop it, and that's why a price goes down. Flip side, when it goes up, right, there's so many buyers and so little sellers because nobody wants to get rid of a really successful stock in this hypothetical scenario, so they keep driving the price up, so on and so forth. Getting into the RSI, I want to show a quick example still on Microsoft, and then we'll go to Carnival Cruise because they're a great example of RSI right after. But so right here and right here, the RSI indicator was above 70. The key levels you want to look at are 70 and 30. And before I am completely done with the MACD, because these all go in conjunction, I want to mention that these signals work the best on the 180-day chart, which is the one I'm on. You can use them on the shorter term charts, but they're most consistent and accurate on the longer term. So at this point, Microsoft was what is considered overbought. Any RSI over 70 means a stock is overbought and most likely is going to be coming back down to equilibrium soon, which is basically anywhere in the middle. The more closer to the middle, the more closer to equilibrium. If you're a little higher, you might be a little on the overbought side. Anything lower, oversold, right? Pretty simple. So right here, if you just followed the RSI, and this is why you want to be using all of these indicators in conjunction, if you just followed the RSI and saw, wow, this is pretty oversold. At this point in time, it was almost all the way up to 80 and you sold. Actually, the stock ended up going up a few more percent. It ended up going up 2%. Now, if you held out for a while, you would have been right because in a week or so, the stock did end up dropping. But this is where if you were looking at the MACD, and we'll get into the moving averages lines themselves, which is this light blue line and this green line, it wasn't really signaling a sell on the other ones. So again, I wanted to bring that up because we'll go to Carnival in a second. I want to see if there's one more better. Here's a really good example. Actually, this just happened the other day. At the time of recording this, it's September 9th. And so the big NASDAQ tech sell-off just happened a few days ago and just started to recover today. So right here, Microsoft was severely overbought. You can see it's in the red and way over 70. Again here, pretty overbought, again, touching 70. And if you followed the sell signal, boom, it was a sell, right? And right now we're starting to get a little bit of a buy signal again, but key thing, again, we haven't got confirmation. So you'd want to wait another day or two if you were going to go off technical analysis. So just really quickly to go to Carnival, because they're a great example, is right here. They shot up a ton, incredibly oversold. I think it got, almost all the way to 90, 85. Extremely, I think I might have accidentally said oversold. It was extremely overbought and then dropped down, and then it started to get almost close to oversold, which can be a good indicator of buying, and then it started coming back up. Now, going back to the MACD, to using them in conjunction, when you see something start to get oversold on the lower end, when the price decreases stop increasing, right? When it goes from bright red to dark red, that's usually a signal of a bottom. So this is when basically the price decreases aren't necessarily happening anymore. When they do happen, they're smaller. And that means that the price increases must be larger. So we could see that was the bottom. It started going up. If you went up to here and then you went off the MACD and also saw that the RSI was getting a little high, it was towards 61. It wasn't necessarily down in the middle. Then it could have let you know that it would have been a time to sell. Now, I wanted to switch over to Wells Fargo to go over the moving average line. So as I said, the MACD is a moving average indicator, but what I'm talking about is actually having the moving averages on the chart. So the way I've set this up is the green line is the simple moving average and the light blue line is the exponential moving average. Now the exponential moving average is a little bit more of a short-term moving average, and we'll go to that on a short-term time chart in a second. But the simple moving average is a pretty solid indicator. It's used for a lot of different things, not just stocks. And essentially when a stock breaks through, goes below the simple moving average, then it's a very bearish signal. And when it breaks above, breaks through the simple moving, it's a very bullish signal that the stock will continue to go up. And again, this is best used on the 180-day, 4-hour time frame. That's what the simple moving average is calculated from. It's calculated from the 6-month moving average, I believe. I could be wrong on that, but I'm almost positive. 180 days. So, and actually while I was looking at that, I'll go back and show that the exponential moving average is based off of 15 days. So if we go and look at something shorter term, like let's say the 10-day moving average, and we zoom in here, this light blue line is essentially like a mini moving average. And I'm going to wrap this whole video up with going over resistance levels and support levels. and it acts basically as a moving resistance and support level. So once a price breaks above it, so right here you could see that the price started going below it, and you only got a few candlesticks. So it wasn't necessarily for sure that it was going to stay below it, because it had this huge price movement at market open, stayed clearly above it, and what do you know? Once it broke through it and had a few candlesticks above it, it continued to go up and up until, what do you know, it broke below it. And once it broke below it, it had quite a bit of a hard time, kind of touched it a little bit to possibly go back over. And so it wasn't really clear at this point. It started to go down, came back up, so on and so forth. The exponential moving average is, here's the 1 day chart. So if you were like day trading, for instance, this is the chart you would look at. It's even better on shorter term, but again, I don't want to necessarily recommend day trading, just showing how it works. When it broke above it right here, it was super bullish. When it broke below it here, it only had one candlestick and then instantly came back up. When it significantly broke below it right here, even though it came back up for a little bit, it still kept going down. Now, the last thing I want to talk about are resistance and support levels. So you may have heard that if you ever watch CNBC or ever watch some financial news, you may have heard some stock traders talking about resistance and support levels, and you may be able to use some intuition to figure out what they are, and they are pretty intuitive. So first off, I'll start by saying that resistance levels for a stock are almost always around round number prices. So we're going to be looking at Microsoft, and I'll prove that point as we go through it. But what's great about Thinkorswim is when you have this drawing tool on, you can draw on the chart however you like. And so basically, once you zoom into a chart, it's really easy to see a resistance and a support level. So right here, these are bottoms. So we'll draw a line at this bottom. We'll draw a line at this bottom, and then we'll draw a line at the tops. So if we zoom in, we can see that this top and this top were both around 217. So it's a round number, but the important part of that is it's close to 220, right? A larger kind of nice sounding number. If we look down here at the bottom, 205, an increment of 5, a round number, same thing over here. And right here was 200, again, a big round number. Now, what's important about these resistance and support levels is using them to your advantage in analyzing a stock long-term and short-term. So right here, almost always a support level, basically what's helping a stock not go beneath a certain price, is almost always a previous high. And that's usually the case. So once a price breaks through a resistance level, basically a price that is keeping the stock from getting through, that usually ends up becoming a support, and we'll go into it right now. So right here, 200, if you draw the line over, what do you know? This was a top right here in June, on June 10th, right? That was a previous top. If you look at this number, 205, which was basically a support right here, we draw this over. What do you know? A top again. So once this breaks through it, you see, if you look at this, 4 or 5 trading days where it just blasted through this 205 support or resistance level, when the stock did end up coming back down, it used that as a support, and people felt comfortable buying underneath that because they thought that the stock would kind of bottom out, and they were right. And again, it was a round number. So once we got this previous high of, it actually looks like it was kind of close to 215, although it got above that for a bit. Once it came back down to this support level and it tried to go back up, it almost got there right here and then was shot back down. This line is basically almost the same for all 3 of these peaks. And then when it came back down, it was a little bit lower. It was the 200 previous support, and then it came back up all the way up to a hair below 220. Now, resistance and support levels are not the end-all be-all. They're not always going to be true. Granted, none of these indicators are always going to be right, and as I've said before in this video, you need to use them all in conjunction. So you need to be looking right here if you were thinking of buying, you're seeing, okay, it's almost oversold. The RSI is pretty low. It's really close to a past resistance level, so this might be a support. The price decreases aren't really happening as largely as they were. And what do you know? If you waited another day, you would see that the MACD indicator signaled a buy. And if you waited just a little bit longer, you would have seen all of that happening. Now, this was a really fast price change. This was just in a couple of days. So this was probably a better example of it dropping down, seeing that the price decreases weren't happening as much anymore. The RSI was a little on the lower side. It was, 38, getting close to 30, so on and so forth. But point being, you want to use these all in conjunction. I'm sure I could have chose a better stock that puts them all together a lot easier, because Microsoft has basically been on an upward trend for the last several months, like most big tech names. But point being, they're not always going to be right. They're not always going to be 100% correct in predicting what's going to happen. The last thing I wanted to mention about resistance and support levels before I wrap this up is that it can be a very bearish signal if a stock completely disregards a past support level, as I'm sure Microsoft did right here when it went down a lot, right? It just broke straight through that previous 220 because it got all the way up to 230, broke straight through it. But what do you know, when it got down to around 200, which it's been a support multiple times and a high once, it used that as a support. So it can, as I said, it can be very bearish when it blasts through one that looked to be pretty strong, like this was around three times. However, it can be very bullish as well when it breaks through a resistance super strongly. Like this wasn't that strong of a resistance level at 200, but when it just blasted through it, it was a pretty bullish signal. If you look at something, maybe Carnival might be a better instance, where actually Wells Fargo is probably better because it's mostly flat. So like Wells Fargo is flat for a while, right? It's been flat for a while, and if it broke through one of these levels, like around, I don't know, 26, or now it looks more like 25, it's on a slight downtrend, that would be a very bullish signal. So point being, they're not the end-all be-all in terms of stopping a stock or prohibiting a stock from moving, but if they do break through them up or down, it can be a pretty bullish or bearish signal as well. Well, that's about it for this video, everyone. Thank you so much for watching. I know this was a little bit of a newer style where I've got the camera going while I'm screen recording, so definitely let me know what you think about this style of video. I really enjoyed it. I thought it was cool showing you all these techniques. Definitely comment down below if I missed something or if you have any questions. I know it was a ton of information, but if you really want to learn how to read stock charts all in one video and get a ton of information, hopefully this was able to do the case. So like the video if you liked it. It really helps me out a lot. Subscribe to the channel if you're new. And again, let me know what you think. Comment down below. I plan on doing some more videos like this. If you want me to do technical analysis on a company, for instance, comment that down below, and I can do my best and let you know what I think from the charts. And maybe I'll do some like live chart analysis sometime, and basically record myself doing this during a live market and see if if I was going to day trade or something like that, would I have been right, would I have been wrong, so on and so forth. So anyway, enough from me. Thank you all so much for watching, and I'll catch you in the next one.